Most people have used money their entire lives without ever once asking where it actually came from. Not philosophically, practically. Like, who made this dollar exist before it was in your account? And the answer is not what most people were taught in school, if they were taught anything at all. The common assumption is that the government just prints money and releases it when needed. That image, a printing press running overnight, stacks of bills loaded onto trucks, is mostly a story. The actual process is quieter, more institutional, and honestly stranger than the simple version suggests. It starts with the central bank. In the US, that's the Federal Reserve. In the UK, the Bank of England. These institutions don't just store money. They are, in a meaningful sense, the origin point for new money. But even that's not the full picture, because central banks don't hand cash to regular people directly. The money that reaches your paycheck, your rent payment, your grocery total, it travels through a system. And the first step in that system is something most people walk past every day without thinking about. A commercial bank. The one with the app on your phone and the branch near the grocery store. Here's what most people don't realize. When a bank gives someone a loan, it is creating money. Not moving money from one account to another. Not lending out someone else's deposit, actually creating it. When a mortgage gets approved for, say, $400,000, that number appears in the borrower's account. It didn't exist before that approval. No one transferred it. The bank wrote it into existence through accounting. This is called credit creation, and it is the dominant mechanism through which new money enters the economy. The Bank of England confirmed this directly in a 2014 research paper. Loans create deposits, not the other way around. That one sentence quietly contradicts what most introductory economics textbooks spent years describing as settled fact. The old story was that banks collect deposits, keep a fraction in reserve, and lend out the rest. That model is called fractional reserve banking, and while it sounds logical, it gets the sequence backwards. Deposits don't come first. Loans come first. The deposit is the result of the loan, not the source of it. Which means every car loan, every student loan, every business line of credit is adding to the total money supply. And every time a loan gets repaid, that money effectively disappears back out of circulation. Money is being created and destroyed constantly in banks tied to debt, tied to repayment schedules and interest rates. This is not a conspiracy. It is the documented mechanics of how modern monetary systems are designed to function. But it raises a real question. If banks can create money through lending, what's actually stopping them from doing it endlessly? The answer is regulation, capital requirements, and something most people feel before they understand it: interest rates. When the central bank raises its benchmark interest rate, borrowing becomes more expensive across the entire system. Fewer people take out loans. Fewer businesses draw on credit lines. Less new money gets created. Demand cools. When rates drop, the opposite happens. Borrowing becomes cheaper. Credit expands. More money flows into circulation. This is why central bank rate decisions make headlines. They are, quite literally, controlling the pace at which money is born. And that mechanism touches your life directly. Whether you've ever taken out a loan or not, your landlord's mortgage rate affects your rent. Your employer's line of credit affects whether they hire or freeze headcount. The interest rate on a car loan affects whether someone buys a new car or holds onto the old one. Money supply isn't abstract. It shows up in the price of eggs, the cost of a monthly lease, the job posting that didn't appear. There's another entry point worth understanding, one that became very visible after 2008 and again after 2020. It's called quantitative easing, and it's the mechanism people usually mean when they say the central bank is printing money. In simple terms, the central bank creates new reserves and uses them to purchase financial assets, usually government bonds. Those assets sit on the central bank's balance sheet. The reserves flow to commercial banks. Liquidity in the system increases. It's not cash falling from helicopters. It's an expansion of reserves at the institutional level, designed to encourage lending. The theory is that more reserves give banks more capacity to lend, which pushes money further into the economy. Whether that transmission actually reaches ordinary people is a different, more complicated, and honestly more contested question. What tends to happen, and what happened quite visibly in the years following large quantitative easing programs, is asset price inflation. Stocks rise. Property values climb. The people who already own those assets see their net worth increase. The person renting a one-bedroom apartment, watching that building's value go up, does not automatically benefit from that process. That's not cynicism. That's just the documented distributional outcome of how new money tends to move through the system. So when someone says the economy has more money in it, that money didn't arrive evenly or neutrally. It entered through specific channels: debt instruments, asset purchases, institutional reserves, and it moved in specific directions. Understanding that directionality matters more than most people realize, especially when you're trying to make sense of inflation. Because inflation isn't just prices going up, it's a signal about the relationship between money supply and available goods. If more money is circulating but the same number of goods exist, each dollar is competing harder for the same stuff. That competition shows up as higher prices. Not because sellers got greedier overnight, but because the math shifted. A useful way to think about it: imagine a town with 10 apples and $10. Each apple costs $1. Now double the money supply to $20, same 10 apples. Each apple now costs $2. That's the mechanism. Real economies are infinitely more complex than that, but the underlying logic holds its scale surprisingly well. And it explains why central banks treat inflation control as their primary job, sometimes more than employment or growth. Too much money chasing too few goods is one problem, but pulling money back out of the system has its own cost. When the central bank raises rates aggressively to slow inflation, it's also slowing loan creation, slowing business investment, slowing hiring. The tool that fixes one problem tends to create friction somewhere else. That's not a flaw, that's the trade-off. Most financial pain people feel during a tightening cycle isn't accidental. It's the intended effect of the policy working. Higher mortgage rates slow the housing market. That's the point. Slower consumer borrowing reduces spending pressure, also the point. The population absorbing that pain isn't always the same population that benefited from the loose money cycle before it. That asymmetry is real, documented, and worth understanding if you're trying to read economic news with any accuracy. Now, there's a version of this topic that gets wrapped in politics very quickly, and it's worth separating the mechanics from the debate. Some people argue governments should create and spend money directly without routing through banks or bond markets. Others argue the current system, for all its complexity, keeps money creation tied to productivity and repayment in useful ways. That debate exists. It's legitimate, but the mechanics described here aren't ideological. They're how the system currently operates. Knowing how money enters the economy doesn't tell you whether the system is fair, it just tells you how it works. And there's genuine value in that knowledge, because most financial decisions people make are downstream of these larger flows. When you see interest rates move, you now have a framework for why that affects your borrowing costs and your rent. When you hear about a central bank expanding its balance sheet, you understand what that means for asset prices and inflation. When you read that credit conditions are tightening, you know that means less new money is being created, and that has consequences. None of this makes the decisions easier, but it makes the landscape legible in a way that vague headlines never do. The practical thing most people can do with this knowledge isn't to game the system. That's not a realistic framing. It's to understand that money supply conditions affect everything: interest rates on savings, borrowing costs, job markets, housing affordability. When rates are high and credit is tight, the cost of carrying debt is real and compounding. That's a moment to be cautious. When money is loose and borrowing is cheap, asset prices tend to inflate. That's a moment to be careful about overpaying. These aren't investment tips. They're just orientation. Knowing which direction the current is moving before you decide whether to swim. Most people spend their financial lives reacting to symptoms without ever understanding the system producing them. The rent that jumped 20% didn't happen in isolation. The car loan rate that surprised you didn't come from nowhere. They're connected to decisions made in institutional settings, through mechanisms that are documented, explainable, and worth understanding. You don't need to be an economist to use this. You just need to stop assuming the financial environment around you is random. It isn't random, it's a system. And systems, once understood even partially, become slightly less capable of blindsiding you. The one question worth sitting with after this: when money in your life feels tight, is it your behavior or is it the system? Usually it's some of both. But most people only ever examine one of those two things.